One of our viewers left a great comment on our RRIF video about the RRSP Meltdown strategy. That's a smart point, and today, I'm going to break it down. Because this strategy can save some seniors thousands of dollars in taxes, but for others, it can actually backfire. Today I'm going to show you who should consider it, and who needs to be very careful. Let's make retirement a little smarter. First, let's talk about why this strategy exists at all. Most Canadians are told to leave their RRSP alone and let it grow until age 71. And on the surface, that sounds reasonable. But here's the problem. By December 31st of the year you turn 71, you must do something with your RRSP. Many Canadians choose to convert it to a RRIF. And once that happens, the government requires you to take out a minimum amount every single year, starting at age 72, whether you need it or not. At age 72, that minimum is 5.40% of your RRIF balance. And it keeps climbing from there. Now here's where it gets costly. Those mandatory withdrawals get added to your taxable income every year. On top of your CPP. On top of your OAS. If your RRSP has grown to a large balance by the time you hit 72, the forced withdrawals could push you into a higher tax bracket and potentially trigger the OAS clawback, which starts at $93,454 for the July 2026 to June 2027 period. That's the trap. The RRSP Meltdown strategy is designed to help reduce that risk. So what is the RRSP Meltdown strategy exactly? It means deliberately withdrawing from your RRSP before age 71, during years when your income is lower. So you pay tax at a lower rate now, instead of a much higher rate later. The idea is to smooth out your income across retirement rather than letting it spike in your 70s. For those who can benefit from this strategy, the window is often between retirement and age 71. Especially before CPP and OAS are both fully running. During that window, your taxable income may be at its lowest point in decades. In Ontario, for example, the combined federal and provincial marginal rate on the first portion of income starts at around 20%. If you can withdraw from your RRSP while staying within a lower bracket, every dollar you take out is taxed at a relatively modest rate. The result is a smaller RRIF balance at 72, lower mandatory withdrawals, and potentially years of reduced OAS clawback risk. Now here's the part most articles skip. This strategy is not right for everyone, and it can seriously backfire for some seniors. If you are currently receiving or expect to receive the Guaranteed Income Supplement, you need to be very careful. GIS is one of the most sensitive benefits in Canada. For a single senior in 2026, GIS is available only if your annual income is below approximately $22,512. And RRSP or RRIF withdrawals count as income for GIS purposes. For many single seniors, each dollar of RRSP income can reduce GIS by around 50 cents. Though the exact amount depends on your situation. So if you withdraw $10,000 from your RRSP thinking you're being strategic, you could lose thousands in GIS payments. That is not a tax saving. That is a net loss. If you currently receive GIS, or your income in retirement will be low enough that you might qualify, the RRSP Meltdown could hurt you more than help you. In that situation, for many low-income seniors, keeping savings in a TFSA rather than an RRSP may be a better approach, because TFSA withdrawals have no impact on GIS at all. So who does this strategy actually work for? An RRSP Meltdown strategy may be worth considering if you have a substantial RRSP balance and you are not receiving GIS. It may also make sense if you have years before age 72 where your taxable income is meaningfully lower than it will be once required RRIF withdrawals begin. The goal is to fill up those lower income years with RRSP withdrawals at a lower tax rate, reducing the future RRIF balance and protecting your OAS. It can help even more if you put the after-tax proceeds into your TFSA, where future growth and withdrawals are completely tax-free. Here is a simple comparison to show why timing matters. Imagine two seniors, both with a $500,000 RRSP at age 65. The first waits until age 72 and lets the account grow untouched. Assuming 5% growth, that becomes roughly $700,000 by 72. At 5.40% minimum withdrawal, the mandatory RRIF income is about $37,800 per year, on top of CPP and OAS. That combination could push total income above the OAS clawback threshold for years to come. The second senior starts withdrawing $25,000 to $30,000 per year from age 65 to 71, staying within a lower tax bracket. By 72, the RRIF balance is much smaller, the mandatory withdrawals are lower, and OAS clawback risk may be reduced significantly. The tax paid earlier is real. But the long-term savings in clawback and higher bracket taxation can be significantly larger. But here's what I want you to take away. This is not a strategy to do automatically. The right amount to withdraw, and the right years to do it, depend entirely on your CPP, OAS, pension income, employment income, and RRSP balance. Withdrawing too little won't move the needle. Withdrawing too much in 1 year can push you into a higher bracket unnecessarily. And for GIS recipients, RRSP withdrawals can significantly reduce the benefits you receive. This is a strategy that requires actual numbers, not just a general principle. Talk to a tax professional or a fee-only financial advisor before you start. Here's the bottom line. The RRSP Meltdown strategy can help if you have a large RRSP and expect significant income in your 70s. It may reduce your lifetime tax bill and protect your OAS. But it can backfire if you are a GIS recipient, or if your income in retirement will be low. The key is knowing your own numbers before you act. For questions about your RRSP or retirement income, call CRA at 1-800-959-8281, or speak with a qualified financial advisor. If this video was helpful, please give it a thumbs up. It really helps more seniors find this information. Subscribe to Wise Senior Canada so you never miss an update, and if you have questions or comments, drop them below. See you in the next video.